Welcome to our investment valuation on Hòa Phát Group HPG. First, we will talk about the overview of the steel industry and the overall HPG. About the industry demand and supply outlook, GDP growth is anticipated to be robust at 6.7% in 2024, suggesting a continuation of economic expansion. Also, the disbursement of FDI in the first 2 months of 2024 rise up to 2.8 billion USD, increased 9.8% compared to the same quarter in 2023. Vietnam can ensure the investment in important real estate and important infrastructure projects, therefore, increase the demand for construction steel. Not only the domestic market, Vietnam benefits from a diversified steel export market, offering a wider range of alternatives for steel type, price, and quality. Vietnam's steel industry is seeing a significant rise in imports, potentially impacting domestic supply dynamics. Vietnam's iron and steel imports have doubled year on year, reaching a staggering 2.65 billion tons. Notably, China is the primary source of these imports, contributing a significant 1.8 million tons. Since most steel products imported into Vietnam have no import tax, China's imports on iron and steel have expanded dramatically in the current situation. As you can see on the chart, HPG accounted for 32.7%, which is the highest in the Vietnam steel segment, making steel the largest revenue distributor of HPG vice versa. Hòa Phát construction steel sale volume increased by more than 32%, lifting Hòa Phát domestic construction steel market share from 33% in Q1 2023 to 38% in Q4 2023. The construction of infrastructure such as 12 North-South Expressway projects, Long Thanh International Airport, and Passenger Terminal T3 at Tân Sơn Nhất International Airport will not only increase the demand for construction steel but also enhance transport connectivity to facilitate real estate projects which consume the majority of HPG steel. And there are some values that make HBG stand out from their competitors. First, strong financial performance. While Fact has shown impressive revenue and profit growth in recent years, they've also managed to increase their gross profit margin, indicating efficient operation. Second, integrated steel complex. Hoàng Phát owns and operates the Dung Quất Steel Integrated Complex, which allows them greater control over steel production process and potentially reduce costs. Next, diversification. While steel is their core business, Hòa Phát has a successful agricultural segment that provides additional revenue streams and reduces reliance on one single industry. And finally, brand reputation. Hòa Phát is a well-established brand in Vietnam, known for its high-quality steel products.
Affect's competitive advantage is cost leadership strategy. We see that in the steel industry, leading units always implement the strategy of integrating a closed production chain, especially upstream development, to create advantages in proactive raw material sources, as well as gaining a significant portion of the added value of the input material process. Affect Group has successfully built closed interlocking blast furnace technology from iron ore to finished steel products, also known as upstream steel production. The closed production process helps Haifa lower production expenses, ultimately resulting in lower prices for its steel products compared to competitors. The low production expense contributes to Haifa's ability to maintain a higher gross margin relative to its peers. About the business model, Haifa Group is different from their competitors because they are the ones that produce and sell steel, others are businesses that buy and resell.
Next, we come to the financial analysis part. In terms of overall evaluation throughout the years, HBG index was marginally superior to the steel industry. Vietnam suffered from devastating effect of the COVID-19 surge, and the country still faced significant challenges related to high raw material prices and decrease in steel demand consumptions in 2022 and 2023. In 2024 onwards, the government policy to protect domestic steel manufacturers and the global steel market recovery have demonstrated HPG's significant development potential. Return on equity is expected to potentially climb to 42.05% by the end of 2028. An expansion in capacity to reduce hot rolled coil will reduce the import of this product, and satisfy more domestic demand. Since then, profit margin is forecasted to rise gradually up to 2028. The growth expansion strategies in the upcoming years will guarantee a steady supply of products for the southern market. In order to transport building steel to the south and to supply product immediately for the southwest regions and Cambodia, HPG expects to invest more than 500 billion VND in purchasing more ports. From there, it's evident that Hòa Phát is expected to raise its liability in the upcoming year due to increased investment in the southern market. However, because of its growth in profitability, it will still raise sufficient cash flow, as seen by the index D staying below 2 and the high OCF from 2024 to 2028.
The steel is beginning to enter the applying stage of ESG to hit to the green sustainable market. In March 2024, the Vietnamese Steel Association have organized a program to support business implementing the environment, social, and governance assessment framework and sustainable business run by the Ministry of Planning and Investment and the United States Agency for the International Development. Precise and implementation through the project to enhance Vietnam private sector competitiveness. HPG is well aware of focusing on sustainability to reduce these impacts, leading to a waste-free world. Since steel production can have many significant environmental impacts, HPG is one of the few companies in the steel industry that takes consideration in the Green Street and report to repair the SES3 report at the end of 2024. This also can help them build a long-term goal and momentum to enter the green capital market. Based on active research and evaluation, we have come up with a weighted score of HBG is 8.7 on MSCI Korea. In the environment pillar, HBG is well aware that the steel production have consumed a lot of energy and electricity to produce the steel and also in the process. They also produce a lot of carbon, therefore they have built high-yield and new work complex and use the state-of-the-art ultra clean heat recovering cooking technology that use clean development machines as an attempt to minimize carbon emission under the Kyoto Protocol. For electricity waste, HPG has built an eco-friendly closed steel-making factories, which refuse the toxic emissions of coal gas during the steel-making process to produce electricity use coke-dry quenching, to which allows heat to be recovering to generate electricity. Although many solutions have been mentioned, but HPG has not disclosed of any result in the annual report, so we rate the environment pillar as mediate. The social pillar consists of policy and welfare for employees, as well as charity projects have been mentioned to support unprivileged households. In the governance pillar, shareholders in HBG account for 34% of the total. Therefore, the distribution of shareholders in the group is divided equally among parties. There is no centralized power in only insider HBG, ensuring independence and comprehension for strategy.
Advantages are acknowledged, but the business strategies were the main factor to maintain the significant growth rate. First is leverage on limited domestic HRC supply. Only about 50% of hot rolled coil is used domestically, which forces steel enterprises to import more. While the supply is in serious scarcity, Hòa Phát with the ability to manufacture HRC allows them to fully self-supply the input for steel that plays a key role in value chain and keep a competitive price of HRC compared to import. Besides domestic market, Hòa Phát also enlarged international footprint through diversified export activities. The advantage of high-quality materials from Hòa Phát Dung Quất Complex helps Dong Hòa Phát export at a competitive price compared to the Chinese steel producers in construction steel. Dong Hòa Phát aim to expand their market to countries even with strict import policy. And also with the growth of operating activities, Halifax still keep their net profit margin optimized despite coal and iron ore prices experienced many fluctuations caused by Chinese market sentiment in the past year. Raw material prices of Halifax did not fluctuate much. Also, blast furnace late 2023 have reduced the burden of depreciation expense compared to the previous time. Therefore, the cost of goods sold is still under control. Good prices remain an important factor, with the average price of HRC and construction steel increased 57% in the fourth quarter compared to the previous year, have thickening their ending net profit margins. Gross profit also enhanced by the increase in selling price exceeding the realizable net value of inventory, which is the basis for the group to re-enter previously set aside provision, reducing the pressure of 150 billion Vietnam dong for the cost of material. And there are still many milestones that Halifax is chasing by the demand with improvements in real estate regulations and foster completion of crucial infrastructure projects like the North-South Expressway and Long Thanh Airport by 2025 to 28. Steel demand in the construction sector, accounting for 14% of total steel demand, is expected to rise. And to catch up the market, the investment in Dung Quất 2 complex, which will be put into operation till the beginning of 2025, is expected to contribute to increasing double HRC output that indicates a strong long-term growth.
And finally, we come to the valuations of Halifax Group. Here we make the assumptions on all the revenue streams to the average revenue growth for 2024 and the constant growth rate from 2025 to 2028, which is an estimate based on the future production of Dung Quất 2. However, our assumptions still exclude some macro factors, and we only focus on the intrinsic growth of Halifax, especially the 4 years that Halifax was struck with the economic downturns. And as you can see, our assumptions ultimately align with Halifax global strategy, which is to increase the revenue but slowly increase the cost of sale. Here you can see the revenue trend over the next 5 years that we have forecasted. About our pricing strategy, we have evaluated Halifax by 3 methods. On the DCF valuation, this pricing is based on the intrinsic value of the firm. We calculated our WACC to be 10.3% based on the debt and equity of 2023 and Halifax future growth rates at 3.5% using predictions on the macroeconomic growth in 2024, especially the HRC steel growth and the residential real estate growth, since they are the main consumption area for the steel industry. So based on the 5-year future trend, by the end of 2024, we estimate that the stock can be up to more than 13%. About the market multiples, here we choose Nam Kim, Ha Sang and Việt Đức as comparable peers since they are direct competitors but also have similar growth rates. We calculated the average EV over EBITDA and PE ratios on the 5-year basis of the 4 firms, and we can conclude if the Halifax stock goes with the overall growth of the steel market, we can see Halifax stock gain a 26.24% upside or 34.76% upside by the end of 2024. So with those results at hand, we recommend buying now, and based on the DCF valuations, which is the valuations showing the true value of Halifax, you will receive a 13% profit at a forward PE with 12.5x by the end of 2024. And thank you for listening.